Okay, everyone, welcome. This is the Macro and Markets Quarterly Update from Beacon Point. I'm Michael Dow. I'm the Chief Investment Officer at Beacon Point. Let's jump right in, but before we get started, a couple of housekeeping items. First, to keep in touch on a regular basis, we've got a couple of really great podcasts out there. Kobe Kress and Karen Reifel host a podcast by the name of Dollars and Cents. It's a really great podcast for financial advice, how to navigate life stages and major life events. Mine's called Markets in Motion, mostly focusing on timely investment and market-related topics. This is Markets in Motion, and we'll be talking about macro and markets today. First, thanks for joining. To navigate the webinar functionality, we will be doing Q&A. There's a couple of view options, a speaker view option in the upper right. Also, there's a Q&A button at the bottom of the screen. So we'll do Q&A at the conclusion. If you type your questions in during, I'll follow them and try to aggregate them so that we can be efficient at the end and I can consolidate similar questions. So with that, I'm going to jump right in. We've got a pretty sizable agenda today. So I'll try to get through as much as I can in the next 45 or 50 minutes, leaving 10 to 15 minutes for questions. But I want to highlight what we've been talking about for the last 7 or 8 months, which is our secular investment theme. It's called financial repression. I'll define that and tell you why it's important as we move through the presentation. Looking a little more near term, our cyclical theme is related to vaccine optimism and reflation of the economy. Section 3 is markets in motion. What are the implications for markets? And the theme there is rates and rotation. And finally, we'll close with some portfolio implications and risks to the outlook. So first, we're going to begin with the overarching theme of financial repression. Why do we care about financial repression? The answer is because of all of the debt issuance that's being done by the federal government in order to fight the COVID recession and replace incomes that were lost based on the government mandated shutdown. What we're seeing here is the budget deficit and surplus. We hit in fiscal year 2020, which ended in September, a minus 16% budget deficit, the biggest budget deficit since the war years back in 1943-44. We're going to see budget deficits for the foreseeable future. And as budget deficits continue to pile up, so will the debt. Here on the right-hand side, we're looking at debt to GDP. So you measure debt not just in its absolute sense, which, by the way, it's approaching $30 trillion now. But we look at it versus the metric for how you pay debt back, which is GDP. So a function of debt over GDP looks like this. The highest we ever had debt GDP was 119. It's 119%. Again, back in the World War II years, just in the immediate aftermath. We're back to 109. We're going to be at 120% soon. And based on the projections from the Congressional Budget Office, we'll be close to 136% of GDP, the highest on record. So we should find a way to reduce the debt because the higher debt levels they tend to dampen growth. And frankly, they increase risks to exogenous shocks. We're not necessarily exposed to the currency type shocks that come from having huge debt levels that a less developed country would have. But it's really important. If you want to have firepower to fight the next recession, you need to get debt levels down. So it's a policy imperative, and it will be accomplished if possible. There's a lot of information on our website about financial repression. We wrote a paper, our research team came out last July. It's called Investing in the Age of Financial Repression. But I'm going to highlight the main features in the next couple of slides. There's only a couple of ways that you can actually reduce government debt, either by growing your way out of it, fiscal adjustment, which is another way of saying balancing the budget. You can default, but that's not really an option here in the United States. Good news is you can do it sort of painlessly, except for savers, by inflating your way out of it, or you can pursue policies of financial repression. The best of all worlds is combining higher inflation and financial repression. So you take a couple of these strategies, you combine them, and that should supercharge or turbocharge the debt liquidation that's required. What we really need, by the way, is having nominal interest rates here in the United States at a very low level. That, by the way, is the definition of financial repression. Add to that inflation that's at a higher level than nominal interest rates, and what you get is negative real interest rates. This is the policy imperative. It's likely to be what we're going to be experiencing here in the United States for the next at least 3 to 5 years. Why? Because it's really hard to balance the budget. That's another good way to reduce the debt loads. But this is the budget going back to 1962. as you can see, there's actually only 5 or 6 years where we've actually achieved a budget surplus. So that's really not an option. It hardly ever happens. So again, defining financial repression, just very quickly, it is official policies that artificially lower a government's cost of borrowing. Why? Because we want to maintain debt sustainability. So if you think about it, if we're issuing all this debt and interest rates rise, the cost of rolling the debt over increases dramatically. So to maintain proper and effective and efficient debt sustainability, we're going to need to reduce the debt load. And at the same time, we're going to need to keep nominal interest rates very low. And in fact, the best way, by the way, to reduce the debt is to make sure that real interest rates, that is interest rates minus inflation, are lower than growth. So you repress nominal interest rates, you let inflation run a little hot, and then you have the government buy up all the bonds that are out there. That's how you repress nominal interest rates, is through quantitative easing. We're already doing it. If for some reason the longer end of the yield curve starts to become unhinged, the Fed will buy more 10 and 15 and 20-year bonds. That's called yield curve control. That's a possibility. It's on the table. It's being discussed at the Fed at every one of their open market committee meetings. And if none of those works, you can actually force the banking system to buy more debt through regulatory requirements, liquidity, and high quality government debt requirements that would allow for them to purchase more and put them on their balance sheet. We really need real interest rates less than GDP growth. That's the key. So financial repression, it's being talked about in DC. We did it after World War II to reduce the debt loads. We're likely to be in that world again. What's the scorecard? How are we doing in financial repression so far? The answer is short rates got taken to zero last March, right at the very beginning of the COVID recession. So short rates are already at zero. Longer term yields are at the lowest they've ever been in 230 years, close to 110 basis points. We've been hovering around 1.15% for a while here on the 10-year yield. And inflation expectations have risen dramatically. Since we started talking about this, inflation expectations are up over 120 basis points. So you've got nominal interest rates at very low levels, and inflation is running a little bit hot. There are significant implications of this for portfolios. But the net result of lower nominal yields and higher inflation is negative real yields. So where are we in that score? This is the US Treasury 10-year inflation protection bond, or TIP. These are the real return bonds. Currently in the marketplace, you're being offered a negative 1% real yield for the next 10 years to hold the risk-free asset, which is another way of saying if you hold a 10-year TIP security for the next 10 years, you will achieve a negative real return of 1%. That's guaranteed. And every time you see negative real interest rates, you should assume that there's some form of financial repression being pursued. It's the hallmark of the strategy. The other thing I want to talk about from a secular perspective, financial repression is not just here in the United States, but it's global. And what we have here is the number of central banks around the world that have actually cut rates in the last year, 26 of them out of the 44 we look at. One has increased rates, so that means 17 have done nothing. The one that raised rates was doing so, that's Turkey, by the way, to protect the lira. But other than that, everyone else is slashing rates. And here you can see the average EM global central bank rate. So emerging market central banks on average had a rate of 5% at the end of 2019, and now it's at less than 3%. Developed market central banks averaged about 50 basis points. They were already very low. If you think about who this really is, the US was at 1 5/8 or 2%, but the euro, the ECB was already at zero, and the Bank of Japan was at zero, but now everybody's at zero. This is the average of the global developed market central banks. It's just above zero. So we're there. This is the repression. This is repression of interest rates. And the imperative, again, is for debt sustainability. So moving on from our secular themes, let's take a look at what the cyclical themes are. We're calling it vaccine, optimism, and reflation. And what it means for markets is that there's been a rotation. So for the last 9 or 10 months, we've been thinking about a framework for asset prices. And it starts with the macro environment. So we're trying to dig as deep as we can and see into the future about developments related to the pandemic, to monetary and fiscal policy, and then marry that with prices. So we're looking at the macro and we're trying to see what it tells us about the future of the markets, but the markets are already telling us something, and that's the valuation levels. So specifically in terms of policy, where politics mattered pre-election, it still matters, but policy is persistent based on who's in charge. So politics do matter, but it's really more about policy. And when we're talking about policy, the only policy that matters that actually will have some dynamism to it, because monetary policy is likely to be on hold for the foreseeable future. But fiscal policy remains a wild card because it's subject to political constraints and political considerations in Washington, D.C. So fiscal policy is the thing that matters, but dominating all are developments related to the vaccine and getting the vaccine distributed and jammed into people's arms as soon as possible. We'll talk about that. So daily cases and hospitalizations are actually rolling over. This was supposed to be I guess was a second wave. It occurred over the summer. The first wave was in March and April. The second wave came midsummer, sort of post July 4th holiday. But then as the weather turned cold and everybody moved inside and the holidays approached, there was a massive increase in the number of hospitalizations and in cases. But those numbers seem to be rolling over. They're actually in pretty good shape. We care most about hospitalizations because if you can keep hospitalizations below the capacity of the local healthcare infrastructure, then you don't have to close down the economy. So that's why we follow hospitalizations. But there hasn't been any talk of recent closures or pauses in many reopenings. It's very localized. It's just not generalized. And those are the things that you care most about. A generalized, like shutting down an entire state because there's a certain number of cases in a particular area, it can be necessary, but if you can keep it local and make sure that you've got hospital beds, things will be all right. The most important thing, though, when thinking about the vaccine and the number of cases is when are we actually going to get to herd immunity, which is the likely key to reopening the economy and a return to normalization. The CDC says vaccinating 75% of the population will allow a return to normalcy. That seems like a long time away, especially since, and looking here at this chart, we're going to get to some kind of a herd immunity, not just because of the vaccinations, which is the blue here, but because of infections as well. There does seem to be some immunity. We still don't know how durable it is. This is all very new. But if you've been infected with the virus, you have some immunity. If you've been infected and been vaccinated, that's the green bar here. And this is the estimate for vaccine distribution over the course of the next 7 or 8 or 9 months. We get to 85% of all of these factors, vaccinations and infections. We get to 70% by midsummer or late summer. Another estimate suggests that the total herd immunity might come in as soon as July. So I'm just going to say late summer. The vaccine rollout seems to be working. We're at 21%. In terms of immunity in today. We'll get to 80% sometime in the summer, as long as there's no disruptions or as long as the vaccine retains its efficacy against any new strains that might pop up, which is always a question. It's a virus we're dealing with. It can't be completely forecast for. So this is the best information we have now, and it's all very positive. And frankly, it's what the market is trading on. How about the rest of the world? Right now, 138 million people around the world have been vaccinated. The total population of the world is just under 8 billion. So you've got less than 2%, but the pace is accelerating. If we can get to 12 million shots a day, and we're trying to get to 2 million here in the United States, if you can get to 12 million around the world, it will still take about 2 years to vaccinate 80%. And it varies country by country. It's going to take us 7/10 of a year. So call it, 9 months all in to get to herd immunity here in the United States. But some countries have been slow off the mark. For example, at the current pace, and you wouldn't expect this to persist, it might take almost 10 years for Canada to get herd immunity. That could have implications. France, Germany, Italy, between 3 and 4 years. So it varies country to country. But let's move on to some more to macro items and talk about exactly what we experienced in the second and third quarters of last year, because the policy implications and the policy response that I'm going to place a lot of emphasis on is a result of this. So you had GDP. This is GDP going back to World War II. It was down 30% and it was up 30%. So down 30% in the second quarter, up 33% in the third quarter. And now it's kind of floating around something a little more normalized, higher than average. It's going to be 5, 6, 7% maybe in 2020, but back down to something more like potential GDP, which is around 3%, 2.5 to 3, perhaps. There was staggering losses, and the response was just unbelievable. But it's important to note, this is all of the data going back to World War II. These are on the same scale. So this is an unprecedented sudden stop in the economy. Again, this is the unemployment rate, so you can see what the health of the labor market looked like through the COVID recession and where we are now. You've got 70 years of data, almost 80, going back to the 40s. And you've got an unemployment rate that peaked at 14, almost 15%. We're back down to below 7 now. So there were staggering losses in employment. We still need more fiscal stimulus to get back to normal. But again, nothing like the economic output loss and nothing like the unemployment and labor force destruction that we saw in the second quarter of 2020. It's just unprecedented. What's the Federal Reserve done? Well, they've managed to take the balance sheet from something on the order of just under $4 trillion to $7.5 trillion. So they added over $3 trillion to their balance sheet, and that's the blue. The orange line here is the S&P 500. So the stock market responded, and this was really important. What the Fed did last March was flood the market with liquidity, and they produced a bunch of different lending facilities where they were trying to cut off the fat tail of bankruptcies in the credit market. So they wanted to support businesses here in the United States. Remember, in a bankruptcy, the equity holder gets nothing. So by saving the bond market, the Federal Reserve saved the stock market. So almost $3.5 trillion of quantitative easing and additional balance sheet brought to bear has gotten us 1,600 points on the S&P 500. That's the way to think about it. By the way, based on current estimates of the quantitative easing program for the Fed in 2021, we should be at close to $10 trillion on the balance sheet by the end of the year. That's just based on their buying 120 billion or so of treasuries and mortgages every single month between now and December. So the Fed's balance sheet's huge. It's approaching 40% of GDP now. At 10 trillion, it'll be half the gross domestic product of the United States, which again would be far and away the largest. Why does it matter? Every presentation should have at least one or two equations. I'm not going to go through this one except to say that this is the quantity theory of money, and it basically says if you blow out the monetary base, if you print a bunch of money, that it should show up in inflation. And inflation is one of the key aspects to our outlook going forward. So. And it's also, by the way, a key driver of Bitcoin and why Bitcoin has risen to the levels that we've seen lately. I'll get to that in a sec. But if you blow up the money supply, it's supposed to increase inflation. And in fact, what the quantity theory of money says is that inflation should be close to 18%. That assumes a whole bunch of things. We're not going there for sure. It assumes that GDP is static, and also the velocity of money doesn't decline, which it did dramatically here. But suffice to say, there's a theoretical or an academic basis for suggesting that if prices rose this much, that you should be seeking an alternative currency, which lends itself to Bitcoin prices being up above 45,000. That was monetary policy. It was necessary. It's going to continue to be accommodative and supportive. That's good for risk assets. The other thing that's good for risk assets is fiscal policy. And right now, fiscal policy has produced an unprecedented response on political time that you would not have guessed. Starting back in March of 2020, we are now at the implementation phase for phase 4. We're going to get that rolled out, and phase 5 is likely to be signed into law. This is the new 1.7 trillion. Right now, it's the 1.9 trillion Biden plan. We'll talk about the difference between the Biden plan and the GOP plan in a second. But all of this fiscal stimulus has been rolled out in record time, and it has done its part. And the Federal Reserve will tell you they need to do more. The federal government needs to do more in terms of additional fiscal stimulus to cut off the fat tails of a depression, which is where we were headed last March. So combined fiscal and monetary policy, that's done very well. I'm going to leave this for reference, but suffice to say there's major differences in a plan that's being offered by the Democratic administration, close to $2 trillion, whereas the Republican plan's at $618 billion. It's currently being debated on the Hill, and we're going to get a substantial bill signed. The Democrats don't exactly need to get to, they have a majority in the Senate, but they don't have 60 seats, but they can get the bill passed through a roundabout way called reconciliation by getting it included in a budget bill. So they're going to be able to pass this bill just as a matter of practical reality at whatever size they want, but the cost will come in the future in terms of bipartisanship. That is, the Republicans may not take kindly to the fact that they're not going to be able to participate in the structure of this bill, and that will reduce their interest in cooperating in the future. But I think it's going to happen given the majority, the very slim, the very narrow majority that the Democrats currently enjoy. Post-election policy, just broadly speaking, it's really all about fiscal right now. There are some legislative priorities that are more likely to be enacted as a result of the Democratic sweep, which we didn't anticipate. We anticipated a divided government right up until early January, when the Georgia runoff swung to the Democrats, surprisingly. The effect on the budget didn't matter if you were going to get a Democratic sweep, a status quo, or a divided government. The budget deficit was still going to get blown up, and the economy was going to recover, and you were going to have modest growth. But the Democratic sweep does give a little extra boost because there's upside in terms of a bigger fiscal package and reduced trade and economic policy uncertainty. But that's going to be taken back in the future, and I'll talk a little bit about that. Markets are going to be positive in the short run because they're focusing on the fiscal reality, whereas ultimately somebody's going to have to pay for all of the fiscal stimulus, so taxes are likely to go up. But the market is currently ignoring that. So that's probably 2022's business, not something we need to worry about in 2021. The biggest point I want to make on this slide is that there's a lot of constraints to whatever policy agenda, whether it's Democratic or Republican. In this case, Democrats face significant constraints given that they don't have 60 seats in the Senate and a very narrow 10 or 12 seat majority in the House. So it's not like there's a mandate here where the more progressive or extreme policies are going to get any kind of attention because they can't be passed. And the most powerful people in Washington, D.C. right now is a list of 5 or 6 centrist senators, including Joe Manchin, the Democrat out of West Virginia, Murkowski, Collins, Romney, 1 or 2 more. That will be the deciders for whoever gets to get to the 50 votes necessary to pass any legislation. There's a lot of constraints. So it's almost like having a divided government when you're this close. So we call it a blue sweep, but it's barely that. I want to summarize a couple of things here and move on to markets. The total fiscal and monetary policy support is here. It's almost $13 trillion, which would be 2/3 of annual GDP. So here's the phase 1 through 3.5, which got enacted in 2020. In 2021, we expect another $2.6 trillion of additional fiscal stimulus. So with the almost $9 trillion we got in 2020 with phase 1 to 3.5 and phase 4 and phase 5 coming in 2021, that's $5.5 trillion worth of fiscal stimulus that will be placed into the economy in an attempt to provide income replacement and support. And that's a big number. Bigger number is over the course of the next 3 years, we're going to see from the Federal Reserve an increase in the balance sheet from just under 4 trillion to something over 11 trillion. So you're going to see 7 trillion more of support. It's not direct support like the 5.5. It doesn't go right into consumers' pockets effectively, but it provides support to risk assets, so the equity market and house prices, which has a wealth effect, which will also translate into higher GDP growth. So having the Federal Reserve doing what they're doing is incredibly helpful. It's not the direct support, it's indirect support, but don't take anything away from it. It's still very potent. And as a result, you combine these two things and you get 13 trillion. And we'll see how that compares to the hole that was created in the economy during the recession in a second. So just taking a step back and looking at global economic activity now, this is the Jpmorgan Purchasing Manager Index. It's a good index to suggest global economic activity. It's split between a manufacturing and a services index. But the point is you had this massive downturn, never seen anything quite like this. Anything with a number on it, less than 50 is a contraction. If it's 50 or above, and it usually hovers between 50 and 55, then that's an expansion, or 45 to 55. If there was a modest contraction, you'd see a print here of like 45. But a 26 or a 23, that's just again, paints a really nasty picture of what the global environment looked like 1 year ago. But we've had this massive V-shaped snapback, and that's good. And on a country by country basis, you can see what that this was pretty much the shortest recession on record. This is the PMIs by country. So the globe is up here. There's a lot of green here. There's a lot of green here because we had this global central banks, as I mentioned earlier, have been spraying the markets, their markets, with liquidity. Here in the U.S., the Federal Reserve has been doing the same. So the snapback in the economy was swift and massive, and again produced the shortest global recession that we've seen. Red's bad, green and yellow. Green is best, yellow is kind of neutral. And you can see any country on the list here, everybody's feeling the support. I'm going to highlight China, by the way, just to note that it was the first country to go into recession, but because of what they did in that country, both in terms of support and frankly locking down, they were able to recover and are the only country to produce, one of the only countries, a major country, to produce a positive GDP print for 2020. So they got out, they were in first and out first, as you can see by the data here. Looking a little more closely at the Eurozone, because one of the things that we're contemplating here is a shift from US stocks into international stocks. So what's the economic environment look like in the Eurozone? Well, overall, growth in the Eurozone looks to be over 4%. We're going to get 5 to 5.5 here in the US, maybe 6. But on a relative basis, this is a really good result, especially after having the fourth quarter come in slightly negative. France is the laggard here, but in 2021, France is still going to have almost 6% growth. Germany, 3.5%. Italy, close to 5%. That's a big print. So things are stabilizing in Germany, in the Eurozone, and they should produce a decent enough GDP print. How about in the emerging markets? I mentioned China was the first in and the first out. So this is China GDP versus the rest of the emerging markets GDP. And you can see it's leading pretty dramatically. And in fact, China's pointed towards a over 8% GDP print for 2021. The BRICS themselves, first quarter BRICS, that's Brazil, Russia, India, China, and South Africa, looking to be 13%, up 13% GDP growth. That's amazing. Asia Pacific in the first quarter, up 9%. That's driven in large part by China, Indonesia, Malaysia. Brazil, on the other hand, looking at emerging markets outside of APAC, is kind of pulling up the rear along with Russia. In 2021, the outlook is 3 to 3.5, whereas India looks like they're going to continue to struggle economically and look more like a minus 8%. So even the BRICS with India at 13%, you can see is a pretty good deal. So emerging market equities look pretty good as a result. So here in the US, there's a couple of things I want to highlight, and that is the US consumer is in pretty good shape. Personal savings rates reached all-time highs of 33%. They're still at 13 or 14%. And that's well above the average. So there's a lot of dry powder available for spending, given that the savings rates are so high. This is a function of everything being locked down last summer and a lot of folks getting a COVID relief check, which they simply banked. So savings rates are high and house prices are high with the work from home and the investments that are being made in housing. Right now, U.S. house prices up 9%, and mortgage rates are down at 3%. So those two things are highly related. Mortgage rates just 3 years ago was 5% for a 30-year fix. Now it's 3% for a 30-year fixed. And house prices have increases have been above 9% recently. So those two things make consumers pretty flush and bodes well for consumption in 2021. High savings rates and the wealth effect from higher house prices. And right now, some areas of the economy are still working at about 40% though. So the consumer is ready to go, but we're still not able to get out and go to a restaurant or go to the airport. Both of those metrics that we follow are high frequency data. Restaurant bookings and airport activity in terms of TSA throughput is about 40% of where we were a year ago today. And those numbers fluctuate around holidays for the airport and frankly restaurant activity, but that's not sustainable. You should expect this number to grind slowly upward, as this number will as vaccinations continue to take hold and herd immunity increases. But these are the numbers that really matter now, and I want to spend some time here. This is the U.S. output gap. What happened in the second and third quarters is we had an actual GDP print that was 11% below what the potential GDP was here in the United States. So there's a level of GDP that our productive capacity will allow for. That's potential GDP. Then when you print an actual number and it's a lot less, that creates a gap. So the output gap is just the difference between your actual GDP and what you could be doing in terms of growth on a potential basis. So we're still operating well below potential at this point. This is as of the fourth quarter. And in terms of the number of jobs in the labor market, which is a significant component of how we calculate or health of the economy, we lost 25 million jobs from the February number. That was the peak. We were close to 160 million jobs, and it dropped to 135 million, and we're back to something closer to 152 million, 151 million employed. So we're still down almost 9 million jobs from the peak. So all that tells you is that there's still a substantial amount of slack in the economy and more stimulus is required. I'm just going to focus on this number because I'm translating the percentage numbers from this slide to the dollars. So this is a output gap in the United States of about 2 trillion, which is what was represented by this minus 11%. So GDP, nominal GDP potential was 19 trillion. We got a print back in March actually it was the June 2020 print of 17 trillion. The difference is almost 2 trillion. So I'm suggesting that the COVID recession blasted a $2 trillion hole in the economy, and we need to fill that hole. So how are we going to do it? Going back to the slide we saw earlier, where the fiscal stimulus direct support is closer to 5.5 trillion. The Fed's quantitative easing support is close to 7 trillion, and the hole in the economy is 2 trillion. So how do we square all of those things? The answer is we don't know yet. So far, we're not back to normal. So even though it was only a $2 trillion hole we could calculate, all of this money still hasn't been deployed. Clearly, the 2020 numbers haven't been deployed, and we're nowhere near getting to 2022 or 2023. So this is what's on tap to fill this hole. What are the implications? The potential is that you can overheat the economy. If you have too much stimulus and you get above potential GDP, if you start printing well above 19, 20 trillion in GDP, then it's possible that you would get persistent inflation. So I'm going to skip this chart. This is the Fed inflation rate, the inflation target of 2%, and just make a statement. The Fed has not been able to get to that 2% inflation rate. So while we worry about it because of all the stimulus that's in train, it has been difficult for the Federal Reserve to actually get to their 2% target. So, will they get there or not? And the answer is we kind of think they might, and here's why. The things that were keeping inflation below the Fed's target for much of the last 10 years were a result of the great financial crisis and, frankly, the inexorable pressure of aging demographics. So the 3 Ds are demographics, debt, and disruption. And those 3 things were weighing on inflation. That means we were more inclined to disinflation, whereas there are some forces of inflation that actually might be more supportive going forward. Quantitative easing is huge. We talked about the quantity theory of money and how jamming all of this liquidity into the marketplace, as long as GDP and the velocity of money remain stable, it should produce much higher prices. So inflation should be much higher. But that takes a long time. The quantity theory of money is only good over 10 to 15 years, but we're at the front end of this most recent QE period. So quantitative easing does have an inflationary impact over the long run, as long as you can squeeze out the output gap or squeeze out the slack in the economy. But here's an important thing to note. Average inflation targeting is something that the Federal Reserve announced that they were going to pursue as their operating framework starting last August. Average inflation targeting means instead of when inflation gets to 2%, they're not going to automatically raise interest rates to cool off the economy. They're going to wait until the average of inflation is about 2% over some undetermined period of time. The implication is clear. The Federal Reserve is going to allow inflation to run hot for a period of time. All of this is going to come back to the portfolio implications. By the way, just to put a fine point on it, inflation expectations are now the highest they've been in 8 years. So right now, the market is expecting 2.3% inflation for the next 5 years, whereas just 6 months ago, it was closer to 1%. Actual inflation, this is the difference. This is what the market is expecting is 2.3. Actual inflation is only 1.5 or less. and it's averaged over the last 10 years, something close to 1.6. But we're going to get some fairly hot numbers coming in April and May because of base effects. That is to say, because the numbers were so low, the actual realized inflation a year ago, this green line, was closer to 1%. When you're comparing year on year, it's going to seem outsized, but it's just a transitory base effect. So the Fed will look through it, but it's still going to be alarming to see a CPI print of 2.7% because we haven't, or 2.9, we haven't seen one in a very long time, especially since current inflation is more like 1.5. So we're going to get some pretty big inflation prints, and it could freak some folks out, but not at the Fed. They're going to look through it. You are seeing some inflation in commodities as well. This is copper, and it follows the ISM. So this is the Global Manufacturing Activity Index. As manufacturing growth expands, then copper, which is an industrial metal, tends to expand too. And this is oil prices. Oil is the highest it's been in 4 or 5 quarters. So oil's up big from where we were a year ago when it actually printed a negative number for technical reasons. But the average oil price since for the last year and a half or year and a quarter has been $40. We're close to 60 now, which is still under the 10-year average, but you are starting to see some inflation in commodities. Okay, so we're getting towards the last 10 minutes or so, so I'm going to have to blow through some of this stuff fairly quickly, but this is important. There's been a bunch of manias in the market recently, and I'll try and talk about them before I get to the rates and rotation thesis. Looking at a couple of figures, this is the margin balances in customer accounts. So what is the availability of credit for placing bets in the equity market on margin? The answer is there used to be 500 billion in those in margin accounts, but now it's closer to 800 billion. So there's a lot more margin available. This might be partly Robinhood related. Certainly the call option volume, this is 30 years of history of call option volume, now 31 million contracts versus a 20 or 30-year average of 4 million contracts on a daily basis. This is the total call option volume. It has exploded. So these two things together actually give us pause. Most market accidents that occur are a result of either higher margin debt or leverage being used in terms of the structure of the instrument, and call options are a levered play on the capital market. So combining these two things make me want to pause a little bit and say, what's going on here? I think potentially one of the places where money is flowing that doesn't make a ton of sense to me right now, especially for investors, does make sense for sponsors and for others. Some of the target companies is SPAC deals. So SPAC is a special purpose acquisition corporation that basically you fund it sight unseen and they go out and they do IPOs. It's a substitute for the IPO market, but these companies are, venture stage, typically very risky kind of companies, and the deals are off the charts. These SPACs are blank check companies because you don't know what the value of the investment is going to be ex ante. You only find out later what they're going to buy. So SPACs are getting a lot of airplay, but I'm not sure if it isn't something that might turn out to be a mania. Bitcoin, on the other hand, at least has a technology that has utility. Tesla and BNY Mellon have made recent announcements that have caused the price of Bitcoin to reach new highs. We're at $47,000 a Bitcoin, whereas we were at $700 back in 2016, 2017. However, it's hugely volatile. So here's the price appreciation, which is why everybody's talking about it. Nobody talks about the fact that, for example, a week and a half ago, it was down 15% one day. So there's a lot of price volatility this is the daily price changes. So up 17, down 13, up 14, down 9. There's a lot of price volatility in Bitcoin. I'm going to say a couple of things about Bitcoin right now. Is it suitable for investments? Maybe. But the first thing you want to know is it a currency? The answer is not if it has that much volatility. It doesn't qualify as a store of value. Is it a medium of exchange? It's getting there. PayPal's accepted it, and BNY Mellon just announced that they're going to be able to custody it. So you need both of those things before you can actually call it a currency. It doesn't have the store of value feature yet. Can we determine how much it's really worth? Is it rich, cheap, or fair? What's the intrinsic value? The answer is no. On the next page, I'm not going to read it. There's 5 different theories and theses of how to value Bitcoin. None of them are satisfactory to me. But does it have a place in a diversified portfolio? Maybe, because if it does mature, attracts more institutional investors, and stabilizes as a store of value, then it might become a gold substitute. but I would think of it more as a call option on the future of Bitcoin technology than I would call it a store of value today. It just doesn't meet the test because of its daily price fall. Here's Bitcoin valuation methods. We're doing a lot of work on it here, but we're just not sure how to value it. And until it can be valued, until you can say it's rich, cheap, or fair, it doesn't qualify shouldn't qualify as a significant portion of anybody's investable assets. For speculative assets, for the little mad money, if you think about it as a call option and you're willing to lose it all, I mean, Bitcoin can go to zero, the stock market won't. Okay, the stock market can go down a lot, but there are assets, there are values, there's fundamental intrinsic value to the companies in the stock market that are above zero. I'm not sure if that is the truth. If there's the exogenous shocks to a potential investment in Bitcoin are unknowable. I could think of one, and that's regulatory. That is, at some point, the Federal Reserve is going to say, we don't want a competition for the US dollar currency, and they might regulate it in a way that makes it less attractive. I'm not forecasting that at all. We're not experts at Bitcoin, but these are some of the things that we're thinking about. GameStop, now that was definitely a mania, and in fact, it didn't look like it back in January, but it has subsequently become almost a poster child for a mania. Why? Well, mostly I think because of social media and the fact that for the first time in recent memory or ever, retail investors had both the wherewithal through, for example, Robinhood, and to organize themselves in a fashion that would and allow themselves to get behind a particular trade idea, which in this case was to torture the short seller, the hedge funds who were doing short selling. But social media was the thing that fueled it, because before, small bets wouldn't affect the marketplace. But subsequent to Wall Street Bets, which is a subreddit account, you now have an organized group that's acting like an institution, but candidly speaking, without an institutional framework for investing. Doesn't mean it's wrong or bad. Doesn't mean anything except that I need a fundamental anchor before investing in anything. And the fundamentals of GameStop and Bed Bath & Beyond and others didn't seem to meet the test. Volatility in GameStop exploded, but so did the trading volume. It got up to 2,500% of the trading volume of the average of the last 5 years in GameStop. This is just the number of shares traded, 141 million shares traded in one day. Now they're down to 50 million shares traded. This is the GameStop price. It peaked on March 26th or 27th at close to $350. It's trading at 50, so it does look like almost a round trip now. And here's short interest in some of these stocks. So the short interest in GameStop back on January 29th, there was 120% of short interest in GameStop. This is Fubo TV, this is Bed Bath & Beyond, and this is Tootsie Roll. What you can see is that all of these stocks have had a ton of the short interest squeezed out of them by the Reddit trade. So from that perspective, it's kind of impressive. It's an amazing thing that you were able to organize those folks and get them to go up against the big boys. I'm not sure if anything was accomplished except a few of the folks that got into the trade at the front end and then got out, if they did get out, probably made a lot of money, but a lot of people bought at 348 and now are sitting there with a stock worth 51. Couple of things. Treasury rates are at 30-year lows, 230-year lows. Sorry, 230-year lows were 50 basis points. That was 7 months ago. And August 4th, the Treasury 10-year note was 51 basis points. It's up 60 basis points since then. So interest rates in the United States are rising, just not at any great degree. So you do have this interest rate increase from 50 basis points, peaked at 117 a couple days ago. Now 10-year Treasury yield's 112, so 1.12%. What has that allowed for in the last 4 or 5 months? This rotation from growth, which dominated performance from the bottom, March 23rd, 2020, until the end of the year. The return on large cap growth was 60%, whereas the return from November 1st to yesterday for large cap growth was 20%. So you see a rotation here. What was the winner is now doing really well. Don't get me wrong, 20% is nothing to spit at, but it's the lowest of the three. What's doing better now? Well, let's go to value. Value was the laggard, and it's now right in the middle. Small caps were doing really well, and they're even doing better now. So higher interest rates are an indicator that the economy is reflating, that we're going to reopen, interest rates will tick up higher. So the more cyclical stocks like value and small caps are doing, and international actually, are doing very well as a result. So that's the thesis of rates in rotation. As long as you get slightly higher interest rates, maybe up to another 40 or 50 basis points before it starts to freak people out a little bit, I think you'll see a continued rotation out of large cap growth and into some of the unloved sectors like small cap and value and international stocks. What else is driving interest rates higher besides the outlook for the economy? The answer is, this is, by the way, higher inflation expectations make interest rates go up. So we've already talked about inflation expectations at now the highest level in 7 or 8 years, and much above the average of the inflation print. So with inflation expectations higher, that will tend to put upward pressure on interest rates. The Fed will try to damp it down given our financial repression thesis, because higher rates make it hard to sustain the debt. But in the meantime, you're going to get a little bit higher interest rates. Here's the other thing. With all the debt we've issued to support incomes and households and businesses during the COVID lockdown or post-COVID lockdown and through the recession, all of that debt is going to be that's supply of U.S. Treasuries that comes into the marketplace. And as we know, greater supply equals lower price, which means for lower prices, you got to pay. People are willing to pay lower prices for Treasuries. That means they demand a higher yield. So more supply in the Treasury market means higher interest rates. So fiscal stimulus is driving a massive amount of bond issuance. This is the last 10 years of monthly bond issuance, and you can see it exploded in 2020. The outlook for 2021 is no different. Also very high deficit, adding to the debt. So Treasury issuance, gross Treasury issuance should be about $2+ trillion or more in 2021. So there's a lot of supply coming online. And the question is, will this push interest rates up so fast that it tests the Federal Reserve's resolve? Maybe. Equity valuations quickly. Right now, our estimate for 2021 EPS, earnings per share, is 175. I just upped this another $10, given how great first quarter 2020 or fourth quarter 2020 results are. The first positive quarter in 4, and the numbers are coming in solid. So if you look at 205 by the time we get to 2020, that's a year from now. So it's 4 quarters, it's 8 quarters, 4 quarters ahead. The PE ratio is a much more reasonable 19 times. It's still well above the average, the 25-year average, but it doesn't look ridiculous. And if corporate profits do recover as we expect, then we figure the stock market will grow into or the earnings will grow into the stock market valuation. So with 60% of companies reporting, like I said, we're going to get a positive fourth quarter 2020 number. But as it stands at 39.10 on the S&P, even at 175 for 2021, we're still trading at 22 times. So the stock market is trading at elevated levels. It's just not outrageous if we get the profit recovery. Equity risk premium, I'll just highlight that it's closer to, it's below the 20-year average, well below the 10-year average, trading closer to the 1-year standard deviation low. What does this mean? It just means, generally speaking, we can handle lower equity risk premiums as long as interest rates stay low. But the point is, if we do get higher interest rates and you have the risk-free 10-year yield competing with equities, which are risky, then that should push the equity risk premium up higher. So, and when you push the equity risk premium up higher, that just means prices are stable or declining. So with very low equity risk premium at 4.4% right now, it was at 7%, by the way, back at the third week of March. That's when you buy stocks. At these kind of levels, maybe less so. But the equity risk premium is pretty low right now, but not if we're in a new lower for longer type interest rate regime. I talked about the rotation. It's just more data showing that the leaders have moved from large to small, growth to value, and from US to international. There's a lot of dollars out there that are being invested at negative nominal yields. So this is just the global aggregate debt that's actually trading with a negative nominal yield, not a real yield, which is adjusted for inflation, but nominal yields. It's really quite a large number. And it's important to remember this is it's not reflective of necessarily healthy economies, but it's reducing as yields start to move upward. So that's good. Finally, I just want to highlight a couple of things. One, This is the implication of higher inflation expectations. So inflation expectations for the next 5 years, 2.3%. If you net that against the yields that are available in either municipal or corporate bonds, let's look at corporate bonds. Triple B corporate bonds yield 2.1%, but if you subtract out the inflation expectation, it's trading at a negative real yield. So that's purchasing power destructive. If you hold that bond until maturity and it yields a negative real yield, then you're losing ground against purchasing power. So higher inflation expectations, which usually are built in one for one into yields, are not happening because of the repression of interest rates that's going on right now. So again, negative real yields in treasuries, negative real yields in municipals, negative real yields in safe investment grade corporates. You have to go to high yield municipals to get a positive real yield. You have to go to high yield corporates to get a positive real yield, given how much inflation expectations have moved, especially in the last 6 months. Really important concept. There's no getting away from this, and we're likely to be in a negative real yield environment for the foreseeable future. Touching on some portfolio implications, I'll just say the summary of our outlook is this: if the vaccine developments continue to move as we think they will, then we're going to get a near full normality certainly by the end of the year, and a lot more normal economic activity by the end of the third quarter. Couple that with fiscal stimulus and the fact that the Federal Reserve is still all on board. You've got vaccine developments, fiscal and monetary policy, and personal savings rates and house prices at very high levels. That would make you want to be risk on for the time being. There are clouds on the horizon. Nothing is that easy, but this is the positive. This is the bull case. In terms of the risk case, or what would keep you up at night, two things: a bunch of exogenous events on the right, and then one thing related to interest rates. This is the interest rate sensitivity in bond land. So corporate bonds have a duration of almost 9 years. Treasury bonds have a duration of almost 7 years. So a 1% increase in interest rates means an 8% drop in the value of your corporate bonds, or a 7% drop, that's a capital loss, in your treasury bonds, because of the interest rate sensitivity that has increased dramatically in the last 2 or 3 years. So the duration of the market, the interest rate sensitivity of the market, is much higher as interest rates have come down. And that means the interest rate, or the duration of the economy, is also very high. So interest rates are the key to the outlook. If they go up dramatically and unexpectedly, then we would be risk off. In terms of the exogenous shocks that are possible and highly impactful, would be a disruption to vaccine distribution, or, as I mentioned, an inflation spike because of this factor here, the duration factor. Probable but not highly impactful would be a reversal of the Reddit trade or the SPAC trade. Something really unlikely but would be highly impactful would be a policy error, whether we didn't get a fiscal deal done, or for some reason the Fed lost their way briefly and decided to raise interest rates. That would be a policy mistake that would be not well regarded by the markets. And a tail risk would be highly impactful, but not at all likely, in my view, would be if you had a systemically important intermediary like a broker or a clearinghouse or something get into some financial distress. That's not likely, but it is a potential market accident that I have to include for completeness. Bottom line is, this remains the same for the last 3 quarters. In the current environment, given negative real interest rates, financial repression, and the cyclical themes that we've discussed, equities look good, particularly a rotation from large cap growth into small cap value stocks and to international. Credit markets are the best. Credit, they've been supported by, they've done very, very well in the last 12 months, given the support from the Federal Reserve. So we've been taking a little bit of profits here in terms of the public markets, but in private investment vehicles, credit still seems like about the best risk return trade-off out there. Given our outlook for inflation, real assets look good. So TIPS, real estate, infrastructure, precious metals, and natural resources, they've all done very well, except for gold, which has been, I think some of the performance of gold has been siphoned off into Bitcoin most recently. Anything that sends you euros or yen or emerging market Forex, that is non-US dollar assets, are likely to do well if the inflation rate goes up here in the US and as real interest rates remain low or negative, given that the US dollar is likely to decline as a result. Okay, so there's a bunch of questions, and I'm going to try to jump in right now. We are at a couple of 5 minutes more time. Hopefully everyone can hang out for a little bit, and we can go through some of the questions that came through. Any thoughts on the relationship between higher debt to interest rates, dollar index, and gold or silver? Higher debt levels usually pressure interest rates higher because they crowd out private investment. Higher interest rates would be good for the dollar generally, except they're being pressured higher by inflation. So that kind of offsets the two. And it's really about the relationship between the US interest rates and foreign interest rates. And US interest rates have come down or collapsed more towards developed non-US interest rates in Germany and Japan. And as a result, the dollar has declined. Gold should do well in an inflationary environment. Silver was part of the Reddit trade briefly, but it's also viewed in some by some as an inflation hedge. But like I said, I think I'm positive on some of the precious and even the industrial metals, given our outlook for higher than recent inflation going forward. Any prediction on a recovery rate or timing of recovery on certain difficult industries like hotels and commercial real estate? 2 years to get back to kind of normal, but if the virus is something that we're going to be living with forever and ever, then we're probably not ever going back to 2019 levels in terms of hotels and travel. I mean, business travel is not going back to where it was, and but commercial real estate's a little different because while people like to get together, office space you would think would be reduced as a result, or demand for office space might be reduced. But I've been talking to some real estate investors who are saying instead of like not going, they're only going to have 80% of their people come into the office, but they have to reconfigure the office so that it accommodates them that same amount of 80% of their population in the same amount of space. So that should be supportive, I would think, of commercial real estate at some point in the future. What do you foresee in digital currencies? It's really hard to say. As I talked about Bitcoin, and the same goes for Ethereum and Dogecoin and everything else. The technology is great. I just don't know how to value it, and as a result, I can't recommend it as a significant component of anybody's portfolio. But I would say you could treat it like a call option, because some wise folks say an asset is anything that goes up or down in price. I say an asset needs an intrinsic value for us to be able to recommend it. So think of it as a call option without an intrinsic value, and the demand seems to be increasing every day. So at what point do markets see more stimulus as a negative rather than a positive? Sometime in 2022, probably, when we start thinking about how to pay for all of the fiscal stimulus, and we have to start to talk about raising taxes, which is something that may get traction fourth quarter this year or first quarter next year. That's the key. I mean, the key is that, or a dollar crisis, which I don't foresee, or higher interest rates that are being pushed up by the budget deficit. Don't see that either. So it's really more about trying to adjust fiscally by increasing taxes, which is something the Biden administration has already said they're looking to do. Why has the Fed balance sheet been essentially level since June of 2020? The answer is because there's been runoff of the portfolio. So mortgage securities and Treasury securities, even though they didn't agree to buy 120 billion a month until December, the December FOMC meeting. So they were buying, I think, 80 billion. And that was what you care about in terms of seeing the size of the Fed's balance sheet increase is what is their net purchases, net of any portfolio runoff. Mortgages have a duration of like 3 or 4 or 5 years, whereas treasuries have a duration of 5, 6, 7 years. So some of the mortgage securities that they're buying and have bought in the past are starting to roll off. So but they'll increase the size of the balance sheet if they need to, and I think they will, because they've upped the purchase amounts. So we'll probably we may not get all the way to 10 trillion in the next year or two, but we're headed in that direction. You mentioned unemployment going to 7. It already is. I've read reports on labor participation has decreased dramatically. So the rate is really higher. That is true. If people start coming back into the labor market, that will affect the unemployment rate. It's the denominator of the unemployment rate. So if the denominator is larger and you have a same number of folks coming back in, that affects the reported unemployment rate. If you have a bunch of people coming back into the marketplace, then the unemployment rate will spike higher, but that would require much higher economic activity than we've seen in the last 8 or 10 weeks. Right now, the labor market, we had a initial jobless claims yesterday that's still over 700,000. So there's still 700,000 or 800,000 people every single week applying for unemployment. So the jobs just aren't there yet. Overweight to Asia, especially Asian equities, is the question. What allocation would you suggest? Any thoughts on Tesla? No, I don't get it. It's not a car company, it's a technology company. And certainly Elon Musk seems to be a genius. And people like the product, but I can't value it properly. It seems overvalued. But I said that a year ago too, so don't quote me on Tesla. Do you see China and Asia growing faster than the West? Absolutely. They have demographics, low base effects, move from rural to from the country to the city. Everything is in favor, and then the ability to grow faster because they have a lower starting point for total factor productivity. So everything points to higher emerging markets growth, and specifically, I like Asia and China better than most, just because those are the fastest growing. That's the fastest growing region in the world right now, and will continue to be. If herd immunity will not be reached in the EU until next year, why do you believe the predictions of them growing GDP by 4 to 6%? Because you don't need full herd immunity to grow the economy. And I think they're going to start ramping up. It'll probably be faster than the 2 to 3 years that we showed. That's just at the current pace. So if they start distributing faster, and the economic growth numbers are, they're mine, but they're consensus, close to consensus. So it just looks they're set for a recovery and a 4 to 6% GDP versus 5 to 6 here, 5 to 7% here in the U.S. seems to make sense. It's just that I like IFA or non-U.S. developed market stocks as well are better than U.S. stocks now because of the dollar play. That's a dollar argument and an argument that valuations are relatively more attractive outside the U.S. because the U.S. has done so well. Things that do really well have lower future expected returns. So that's why we have to look elsewhere. Gold going in the short, mid, and long term. Short, can't say. Mid, probably sideways or higher. It depends on Bitcoin for some reason. Bitcoin seems to have dragged some of the performance, pulled some of the performance from gold. But in the long term, it will continue to be I think viewed as a clumsy and cumbersome store of value. But until Bitcoin stops gyrating 15% every day, then it's not going to be replaced by gold. Will not be replaced by Bitcoin. 2021, where do you see 30-year mortgage rates moving? 2021. So nowhere, maybe up a quarter, maybe up a half, but that's it. Probably not lower. So at from 3 to 3.5% would be a guess. Muni is a good investment. Yes, high yield munis are a good investment now. Negative yield expectation. Why should we not invest? Negative yield expectation. Should we not invest? No. If you took all the money out of bonds just because they're negative yielding, you need to move down the credit spectrum and try to find positive real yields. But bonds will continue to play an excellent role in terms of hedging and dampening of risk. So you should continue to hold bonds. Should we move from growth equities to more to value? Yes. There are talks about Bitcoin, investing in blockchain assets. What's your opinion of investing in blockchain assets? Again, I think most of what I have to say about, I think I'm more positively predisposed to broad applications of blockchain. Clearly, it's a great technology and it will dominate contract writing, maybe currencies at some point, and other financial transactions and a way to transfer value. It seems like it's a great technology. So I like that, and it's more diversified than just owning Bitcoin. Do REITs make sense? Yes, because real estate is a good hedge for inflation. What are investment options for endowments? Fixed income investments. Private credit is a good one. Will there be an effect on the markets as a result of the second impeachment trial? No, it's a sideshow. How do you think a $15 minimum wage will affect the economy? The CBO just came out with a report written by a good friend of mine, Phil Swagel, who runs the CBO, and suggests that we'll be down 1.4 million. It costs us 1.4 million jobs over the course of the next 5 years, plus or minus. So minimum wage, there's a lot of controversy about whether it is job destroying or not. Most economists that have a predisposition to free markets think it's job destroying, that would be one view. The other view is that it makes up for it. How are you weighing the possibility of vaccines becoming less effective as the virus mutates? I do not. I'm not an epidemiologist. I'm hopeful. How are you accounting for recent polling suggesting that 1 in 3 Americans will opt not to get the vaccine? I think, frankly, that as we get through this, people will make a decision based on their own personal situation, and if there's more information available, that might be more predisposed. I think if 1 in 3 don't take it, you'll get 66% too, and that might be close enough. What sectors of the S&P would you recommend if inflation raises its ugly head? I think just real assets are the way to go. So that's the last question I have here. Should we continue to invest in tech equity? Yes, it's just less so would be my quick answer. That's it. There's a lot of questions. If there is anything else, please don't hesitate to reach out to me directly or to your advisor or consultant. I've enjoyed presenting this information. If there is any further follow-up, again, I'm available. I want to thank you all for joining. Thank you very much for those of you that are Beacon Point clients. We appreciate your business, and I look forward to speaking to you again at our next Macro and Markets update, which will be in May. Thank you, and good afternoon.